Lesson number 1 from 3 Value Investing Masters. Master this before stock picking. Most new investors charge into the stock market full of adrenaline. They start by studying candlestick charts, learning about golden crosses and death crosses, chasing tips on how to catch limit up stocks, and some even pay for courses on quantitative stock picking. They think mastering these skills is the key to making money. The result? They either get overwhelmed by complex indicators or lose 20% on a stock soon after buying it using a technique. In reality, the very first lesson for beginners from 3 investment masters, Warren Buffett, Charlie Munger, and Philip Fisher, isn't about learning techniques at all. It's about mastering one more fundamental thing first. First, clearly define what you absolutely will not touch. Establish your risk bottom line. Then talk about how to pick stocks. Today, we're breaking down the first lesson from these 3 masters. Newbies, don't rush to learn stock picking. First, get clear on what not to do, and you'll avoid 80% of the pitfalls. This is more effective than learning 10 techniques. Buffett's first lesson. If you don't understand it, don't touch it. Then learn how to understand. When Buffett first started in investing, the first thing his teacher, Benjamin Graham, taught him was, you will never make money outside of your circle of competence. If you don't understand something, no matter how tempting, don't touch it. Buffett later made this the core advice for beginners. During a 1998 speech, he specifically emphasized, the dumbest thing a rookie can do is use real money to buy a company they can't explain how makes money. Example, a newbie, having just learned that a low P/E ratio means cheap, sees a new energy car company with a P/E of only 8. Thinking he's found a treasure, he goes all in. But he doesn't even know what cars the company mainly sells, who its customers are, or if it has any core technology. Later, the company faces a scandal over faked sales figures, and the stock price drops 60%. Only then does he regret not following the rule. If I don't understand it, I don't touch it. The essence. Buffett's first lesson is about making beginners admit their ignorance up front. Acknowledge there's a lot you don't know. Don't dare to buy anything. Early in his career, he only bought understandable traditional businesses like textile mills and candy companies. It was only later, after he understood consumer and financial sectors, that he gradually expanded his scope. A beginner jumping straight into complex fields like AI or quantum tech is no different from crossing the street with their eyes closed. Munger's first lesson. First, learn not to trade frequently. Then learn how to trade. Munger often said that a new investor's biggest enemy isn't the market. It's their own itchy trigger finger. The urge to trade every single day is overwhelming. Frequent trading eats away at your capital with fees and increases the risk of missing out on real gains. His first lesson for beginners is very simple. First, try to trade only once a month. If you can manage that, then talk about learning techniques. A sobering data point. The average new investor in the A-shares market trades about 15 times a year. Brokerage fees and stamp duty can eat up 10% to 15% of their initial capital. In contrast, Munger and Buffett trade on average only 2 to 3 times per year. Their transaction costs are almost negligible. Example, a newbie learns about swing trading and starts watching the market daily, buying low and selling high. He trades 20 times a year, spending 5,000 renminbi just on fees. Starting with 100,000 renminbi, he ends up not only not making a profit but actually losing money once fees are accounted for. The essence. Munger's first lesson is about teaching beginners self-control first. Investing isn't a video game where you grind dungeons. You don't need frequent activity to feel relevant. As he says, the big money is not in the buying and selling, but in the waiting. If a beginner can just look at their portfolio once a month and trade only once, they've already beaten 70% of retail investors. Fisher's first lesson. First, exclude companies without moats. Then select ones with moats. Philip Fisher is the pioneer of growth stock investing. But his first lesson for beginners isn't about how to find growth stocks. It's about how to exclude fake growth stocks. The core idea. First, learn to identify if a company has an economic moat. If it doesn't have a moat, don't touch it no matter how fast it's rising. In his book Common Stocks and Uncommon Profits, he gave an example. A rookie sees a bubble tea chain stock whose revenue grew 50% in half a year. Having learned the growth stock technique of looking at revenue growth, he rushes in to buy. However, this bubble tea shop has no secret recipe, no stable supply chain. As soon as a competitor lowers prices, all its customers leave. Revenue plummets, and the stock falls from 20 renminbi to 5 renminbi. Fisher said, companies without moats rise fast, but they fall even faster. For a beginner, touching these is like handing over money. The essence. Fisher's first lesson is about training a beginner's vision. Don't be fooled by numbers like soaring revenue or double profits. First, ask if the company's advantages are durable. Mutai has a brand moat. Others can't steal its customers. China Yangtze Power has a resource moat. Others can't build the same hydroelectric dam. By first learning to exclude the junk stocks without moats, what remains are naturally more reliable investment targets. The beginner's action plan. First, list your 3 absolute no-go zones. Then learn techniques. The first lessons from all 3 masters point to the same thing. First, establish your risk bottom line. Know what you won't do. Then learn how to pick. As a beginner, don't rush to learn K-line charts or valuation models. First, take 10 minutes to write down 3 absolute no-go zones on a piece of paper and follow them. No-go zone number 1. If I can't explain how it makes money, I won't touch it. Before buying any stock or fund, ask yourself, what does this company sell to make money? Can I explain it in one simple sentence? Example, good. I'm buying Kuaichao Mutai because it makes money selling premium Baijiu. Or, I'm buying an S&P 500 ETF because it makes money from the profits of 500 leading American companies. Example, bad, a metaverse concept stock or a quantum computing stock whose business model is unclear. Cross it off the list. No-go zone number 2. I will not make more than 2 trades in a single month. Set a hard rule for yourself. Maximum 1 trade per month. No matter how enticing a rally looks or how scary a drop seems, force yourself to wait until the end of the month before deciding. Example, if you bought a stock on the 1st of the month, don't sell it even if it's up 10% a week later. Wait until the 30th to reevaluate. If it's down, don't panic sell. Observe it first. This trains discipline and avoids losing money on fees. No-go zone number 3. If it has no durable competitive advantage, moat, I won't touch it. Before buying a stock, ask, can a competitor easily copy this company's key advantage? Example, Good Moat, a soy sauce company with a century-old brand and stable distribution channels that others can't replicate. Example, No Moat, a generic garment factory that competes only on low price. If a rival undercuts them, they lose. If it has no moat, no matter how cheap it looks, don't touch it. Final word. For beginners, not losing is more important than making fast money. Many beginners think, getting started means learning techniques to make money quickly. They forget that the first step in investing is to preserve your capital. If you start off by stepping into a trap and losing 50%, you need a 100% return just to break even. The first lessons from all 3 masters teach beginners how not to lose first. Don't touch what you don't understand. Don't trade frequently. Don't touch companies without moats. If you can do just these 3 things, you have already preserved your capital. Then, learning techniques actually has meaning. It's like learning to drive. No one starts by learning to drift. Everyone first learns to obey traffic lights and use the brakes. Investing is the same. Beginners shouldn't start by learning to catch limit up stocks or time market swings. First, learn what not to do. Master this one thing first, and you will already be ahead of 90% of the beginners who are frantically rushing to learn techniques. Remember, sometimes slower is faster.